ARM Holdings is an interesting AI company with proprietary technology that some of the most popular companies in the world pay to use. The company generates licensing and royalty fees, which are high margin businesses that has a lot of investors attracted to this company. But what's the stock actually worth? What's the intrinsic value? What's a fair price to pay for ARM Holdings stock? That's the question I'm going to answer in this video, conducting a discounted cash flow valuation for ARM Holdings stock. But don't get intimidated. I'm going to share with you precisely where I'm getting all of the numbers and which estimates and adjustments I'm making so you can follow along and see how I'm deriving this value. You don't need a degree in finance. You don't need to have taken my university course in finance to understand this discounted cash flow valuation. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the numbers I'm going to need is the beta for the company to do my weighted average cost of capital. And according to TradingView, the beta for ARM Holdings is 4.46, which is really high. And I'm going to adjust this beta downwards to a more normalized level. And I'm also going to do a scenario analysis using various betas to come up with the valuation of ARM Holdings stock, because this one number has such a large influence on the company's valuation. I'm going to use several different point estimates of this number so we can see scenarios across where valuation could be as the beta of the company changes. And I'll also explain why beta plays such a big role in valuation. I also need the company's market cap, which is $145 billion. I need the company's cash too. It's at $1.5 billion. ARM Holdings has zero long-term debt, and the number of shares outstanding are 1.063 billion. I also need the estimated cash flows for ARM Holdings over the next several years, starting with 2024, which is 910 million, 2025 at 680 million, 2026 at 1.94 billion, 2027 at 2.55 billion, 2028 at 3 billion, and 2029 at 3.73 billion. This is according to Wall Street analysts that are following ARM Holdings stock. This is their estimates of where they think the company's free cash flow will be over these next several years. And so I'm incorporating that into my valuation by inputting these cash flow estimates over the next 5 years. And then from that point on, I'm estimating a growth rate for ARM Holdings stock in the transition period, and then finally calculating a terminal value for ARM Holdings, which I'll share with you precisely how I'm doing each of those things I highlighted here. All right, so now that we have all the numbers, all the inputs for our model, we can jump into the discounted cash flow model. So this is as of December 9th, 2024. Let me draw your attention to the upper left-hand corner, free cash flows, which I shared with you where I got these numbers, right? 910 million, 680 million, 1.94 billion, 2.553, and 3.73 billion over these next 6 years in free cash flow. I got that from the Wall Street analyst estimates of what their numbers will be. Now, remember, these are cash flows expected in the future. Of course, for all of us, money in the future is worth less than money today. And so we need to discount those dollars back to today. And that's the numbers you see underneath, the discounted value of those cash flows. How much this cash flow in the year 2029 would be worth today. And that is $1.68 billion. When I sum up all of those present values, I come to the conclusion of 15 billion. So this is where the beta comes into play. When you're discounting cash flows, you need to use some discount rate, right? At what rate are you going to discount those cash flows? Well, to make that calculation, it's called the weighted average cost of capital, where you combine the cost of a company's debt, how much are they paying in interest expense, which for ARM Holdings, it's zero, right? Because I shared with you, they have zero debt. And so all of their cost of capital is cost of equity. And to get the cost of equity, I use the capital asset pricing model, which takes the risk-free rate and adds a risk premium to that, because if you invest in a government bond where you're getting 4.5%, that's coming with theoretically zero risk. If you're going to move your money away from that zero risk asset into a risky stock, you're going to require more in return, right? Because you're taking more risk, so you're going to require a higher return. That's where you get the higher cost of equity. So for ARM, that weighted average cost of capital is really high at 17.24%. And it's because of the beta. I've adjusted downward the beta of 2.25, and I'm using a risk-free rate of 4.2% with a market risk premium of 6%, which gives me the capital asset pricing model cost of equity at 17.7%. Now, even though the company has zero debt, I'm targeting their capital structure at 95% equity and 5% debt. Because most companies eventually take on debt, because as you'll see, the cost of debt is much lower. So even if a company doesn't need debt, they will still borrow money and they can utilize it for some purposes. If they don't have any purpose for the debt, they can just utilize debt and pay a dividend or buy back shares. And so most companies will do this eventually. And so that's why I give them a 5% debt weighting, even though they have zero debt. And I assign them a cost of debt of 8.5%. So all of that gives me the weighted average cost of capital of 17% for ARM Holdings. What that means is for every year, I'm discounting that money by 17% because I'm not having that money in my pocket today. That's money that's owed to me several years into the future. And so when I discount all of those cash flows with this 17% rate, I get the present value of cash flows of 15 billion. Importantly, from the year 2029 on to 2034, I'm increasing or forecasting an increase of the company's free cash flows at 16.35%. The reason I use 16.35% is I'm using half of the near-term growth rate. Over the near term, Wall Street analysts expect the company to increase cash flows by 32.7% over the next 5 years. And so for the 5 years after that, I have the company's growth rate slowing down by half to 16.35%. And then from the year 2035 onward, I have the company growing at a long-term growth rate of 6%. So what I'm doing here is I'm expecting the company's growth in free cash flows will slow down as it grows further and further, right? That's typically what happens. As a business grows larger, the rates of increase slows down. And so that's what I'm forecasting for ARM Holdings. Now, this terminal value figure you see here, this collects all of the company's expected cash flows from the year 2035 onto infinity, because theoretically, a company can survive forever. And as an owner of that business, you're entitled to those free cash flows forever, as long as the business remains in existence, which theoretically can be forever. So instead of individually forecasting all of those free cash flows, you can use a formula to get the terminal value, which equals the free cash flow 1 year ahead, divided by the weighted average cost of capital minus the growth rate. And that gives you the terminal value, which you also need to get the present value for, because this is the value in the year 2034. The present value of that is 15 billion. Combined, the value of operations is $30 trillion for ARM Holdings. Or I'm sorry, $30 billion for ARM Holdings going forward. So these are the present values of the cash flows expected from ARM Holdings from now until infinity. And I've demonstrated how I'm calculating all of those cash flows. We're not done yet. We're almost there. So to this total, we need to add the company's cash, and that gives us a value of equity of 31.9 billion. And we need to divide the number of shares with this number to give us our price per share. And when I do that, that brings me to an intrinsic value per share for ARM stock at $29.98. And that's way lower than the current market price of $139 per share as of this recording. So why is the stock price so overvalued compared to the intrinsic value? I think a lot of it has to do with the beta. So I've done several scenarios here. If the beta, instead of the beta being 2.25, if the beta was 1, my intrinsic value per share calculation would have the stock at $95 a share, closer to the current market price, but still indicating overvaluation. At a beta of 1.5, the price would be $52.80. At a beta of 1.75, the price would be $42.49. So the real driver right now of ARM Holdings stock is the higher beta, the higher cost of capital, which I think will decrease going forward because the company will take on more debt. The company will have more history in publicly traded markets. The price will be less volatile and the beta will be lower. That's why I've conducted these different scenarios. Still, my intrinsic value per share in all the scenarios I've forecasted has ARM Holdings stock as being overvalued compared to my calculation. But remember, the market price may never agree with me and might always remain overvalued. And so this doesn't mean that the price is going to come down. It just means this is what I think these shares are worth according to my estimates. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.